mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Pool Locke YouTube channel. I'm James Locke. Today we're going to answer some more Ask James questions of the day. First question is from Dan. You said there were 3 types of mutual funds, but I think there's more than that. What about foreign funds or balanced funds, for example? All right. So Dan, you're really, I get it. You're absolutely right. And I appreciate the kind of correction. I sometimes simplify things intentionally, right? Because, I give broad categories, right? But you are right. Within each category, there's a whole universe of subcategories and different combinations. So, for example, within stock funds, you can get into large cap funds. They focus on big, established companies. Small cap funds focus on smaller companies with more growth potential. And there's growth funds that emphasize momentum and higher price to earning ratios. And then there's value funds that look for undervalued companies that often carry higher dividend yields. And then, yes, you have international and foreign funds, which are subcategories of the stock fund world focused on companies outside of the United States. Now, within bond funds, you can distinguish between government bond funds, corporate bond funds, municipal bond funds, which have their own tax advantages, and blended funds that hold a mix of all the above. And a balanced fund, as you mentioned, is simply a fund that holds both stocks and bonds in some combination, designed to offer maybe a middle path between growth and income. And then there is the ever-expanding world of exchange-traded funds, which includes everything from simple index trackers to actively managed strategies to some very specialized products, including things like Bitcoin ETFs and commodity funds. And that, they're really in a category of their own. So yes, I was definitely oversimplifying. The universe of funds is enormous. But for our purposes and descriptions on shows like this, for most retirees really, thinking about income and principal protection, the 3 broad categories, stock funds, bond funds, money market funds, are the right starting framework. Everything else is a variation on one of those themes. But thanks for keeping me honest. Hey, great question. Keeping me honest, like I said there, if you want to try and keep me honest, shoot me an email. You can email me at poollocke@poollocke.com. Our second question comes from Keith. He says, how are exchange-traded funds different from mutual funds? All right, Keith, great question. And this one comes up a lot. ETFs, exchange-traded funds, are in many ways very similar to mutual funds. They're pooled investment vehicles that hold a diversified basket of securities. The key difference is how they trade. A mutual fund is only priced once per day at the close of the market. If you put in a sell order at 1 p.m. and the market drops significantly between that 1 p.m. order and 4 p.m. close, you're going to get less than you expected. There's no way to lock in an intraday price. What you see on your screen at noon is not what you will get when the trade settles. An ETF, by contrast, trades on an exchange just like a stock, all day long during market hours. So you can buy or sell at whatever price the ETF is trading at that moment. You can set up stop losses, right? Stop loss orders, instructions that automatically sell if your position, if the price drops below a certain level, which gives you a layer of downside protection that mutual funds simply do not offer. You can also, for non-IRA accounts, borrow against ETFs on margin, though that's a tool I would encourage most retirees to use very cautiously, if at all. Now, ETFs first became popular as a low-cost way to track major indices. The SPDR is SPY, which tracks the S&P 500. The Qs, QQQ, which tracks the NASDAQ, were among the first, and they're still the largest. Their expense ratios are fractions of a percent, and that is genuinely inexpensive. But here's where it gets more complicated. Today, many ETFs are actively managed ETFs. They have portfolio managers making decisions just like a mutual fund. And when that is the case, the fees can be just as high as a comparable mutual fund. The ETF wrapper does not automatically mean low costs. You have to look inside. So my advice is always the same. Do not get distracted by the packaging. Whether something is called a mutual fund or an ETF, the questions that matter are the same. What does it own? What is the yield? What are the all-in costs? How does it behave in a downturn? And does it actually generate the kind of reliable, predictable income a retiree needs? Now, for most retirees building an income-first portfolio, individual stocks and bonds selected for their dividend yield, credit quality, and income stability will outperform both mutual funds and ETFs on the dimensions that matter most: predictable income, principal protection, tax efficiency, and customization. That is the core of what we build for clients at the Retirement Income Source. Great question. And hey, if you want to send in your question, you can do that. Email that question to poollocke@poollocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your Retirement Income Source, and I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear.